Why do you think it seems like banks aren't buying as many bonds as they have been? They're hoarding more cash. They're using the reverse repo operations to park their cash overnight. Why are banks holding cash? What's going on here?
Well, they're not really holding cash. They're just lending their cash to the Fed. They're
Right.
buying U.S. Treasuries. What they don't want to hold are corporate debt. They don't want to hold, higher yielding bonds from banks, private banks, not the Fed, or corporations. And the reason is because the yield is not high enough. The spread, the extra income that they earn by taking the added credit risk, right, is not worth it. Because if we're going into recession, that means a lot of these bonds are going to go into default because a lot of the issuers aren't going to be able to repay. And since the yield premium is so slim, the banks want to play it safe. They want to put their money with the Fed because at least they know there that they're going to get it back because the Fed's not going to default because it's got the pretty press. But having a pretty press in the big scheme of things doesn't mean much because they print the money till it has no value. But it shows you that the banks are worried about credit risk. Why are they worried about credit risk? Because they're worried about recession.
That's interesting. So, tell me if this bottom line is right. So the bond market's trying to price through the entire cycle. So they believe that in the future, the Fed's going to have to come back in after the taper and after a disaster. The bond market is pricing in the fact that the Fed's going to have to come back in, buy a ton more bonds, creating more demand for the bonds that they now own, driving up the prices of those bonds again in the future.
Yeah. I mean, they're looking past, they're like, okay, the Fed's going to step on the brakes. The economy is going to tank or going to be back in recession. Then they're going to have to, launch more QE. They just expect that the Fed can keep doing what it's been doing. Because if you look at all of the past cycles, the Fed prints a lot of money, causes an asset bubble. Eventually they raise rates or something happens, the bubble pricks, and then everything collapses and they start all over again by slashing rates. But every time they cut rates, they have to go lower than they went before. Well, we're at zero now, so you really can't go any lower. Then they started QE, but every time they do QE, they have to do bigger than they did before. Just like drugs, when you're doing drugs, you need more and more of the drug because you build up a tolerance. The bond market assumes that we could just do this indefinitely. They're wrong. The Fed is going to destroy the value of the dollar, right? We're going to overdose on this QE. And when the dollar is destroyed, bonds are destroyed. That's what the bond investors don't get. Bonds are just future, payments of dollars. And if the dollar is losing value in the present, then dollars in the future are even less valuable than the dollars today. And that's what bondholders are holding. So we are headed for a massive sovereign debt crisis. And again, not just sovereign debt, but bonds. The big losers are going to be the creditors, the bondholders, the people who have cash, the bank, the people that have fixed annuities, cash value and insurance policy. Everybody's getting wiped out here, right? The winners will be the owners of assets and the debtors that have assets but also owe money against those assets. But of course, the biggest losers will be the average American worker who's totally screwed. Although the retirees are going to get screwed the most, right? So if you're my age, I'm 58. If you're thinking about retiring or you're already retired and you've just got a pension, an annuity, some Social Security, I mean, you're completely screwed. You're just going to get wiped out. At least if you're a 20-year-old, you don't have much to lose as far as your retirement savings. But we're going to be living in a much poorer country. And, so real wages are going to just implode in the United States as a result of this inflation. And, Americans are not going to be able to take their paychecks and buy all these products from China and places like that because they're not going to be selling those products for our dollars anymore.
Before we continue, help us by smashing that YouTube like button and subscribe now to this channel. This shows the algorithm that you value the information, and it helps us spread this message. Sharing is caring. Please like and subscribe now. Thank you. And now let's continue.
Why do you think the dollar market's not falling yet if the markets are trying to look forward to this?
Same thing. I mean, they're not looking forward to this. They're not looking forward to reality. They're looking forward to fantasy, just like the bond market. The dollar market, right? See, the dollar traders think, aha, inflation is hotter than the Fed thought. The Fed is going to be raising rates sooner than later. They're going to be tapering, and that is supposed to be bullish for the dollar. And so this is just all in an algorithm, right? These commodity traders or currency traders, they just program their algorithms, and anything that means rates going up sooner is bullish for the dollar. That's why it's so perverse. If the inflation numbers that would have come out early this morning were lower than expected, the dollar would have tanked. The dollar rose because of higher inflation. And that may seem counterintuitive because higher inflation means the dollar is losing value faster than we thought. Right. So if the dollar is losing value faster, why would you want to buy more of them? Why would you want to pay more for something that's losing value even faster? It's because of what investors expect the Fed to do as a result of that. But they're wrong. The Fed not going to do that because they can't do that because people aren't connecting the dots. What would happen if the Fed actually raised rates to fight inflation? The markets would crash, stocks would crash, bonds would crash, we'd be in a recession, and then the Fed would cut rates back to zero. They would print more money. So if they try to fight inflation, they end up having to create even more inflation. So they're in a situation where fighting inflation is impossible. The only thing the Fed can do with inflation is fuel the fire.
Now, in the CPI this morning, they mentioned that 1/3 of the increase came from used cars. What happens when?
I think it was the biggest increase in the history, and it's the third month in a row. But it's like, the biggest gain ever for used cars and used trucks. Yeah.
So what happens when people have their used cars or these supplies catch up and all of a sudden that turns into deflation? Isn't that going to pull the whole index down?
If used car prices stop going up?
Yeah.
Well, it depends on what else is happening. Other prices are just starting to rise. But I mean, used car prices go down, but the way they're measuring them, it's not the same car, right? Like if I buy a used car today, obviously the price of that car is going to go down. But what they're measuring is the price of used cars from this point in time going backwards, right? Not like, hey, obviously cars depreciate every year. So if I buy a car this year, right, it doesn't mean it's more expensive. So if you bought a used car last year and hey, prices are up, that doesn't mean you can sell your used car for a profit, right? Because now that car is even more used than when you bought it. It's what are the prices of a car that's 1 year old, right? Any given day. So I don't think we're going to see a big drop in used car prices because I ultimately think we're going to see a big increase in new car prices. And as long as new cars are going to get a lot more expensive than the alternative, a used car. And if the dollar really tanks, which is what I think is going to happen over the next few years, a lot of our used cars are going to get exported. Right? They're going to be put on ships and sent to Asia and places like that. So think about how expensive used cars are going to be when Americans have to start competing with the Chinese to buy those cars.